In late December of the year 2025, three distinct alerts blare out concurrently across disparate segments of the global financial architecture. In New York City, equity market valuations have ascended to heights surpassing both the peaks of 1929 and the dot-com boom of 2000. The S&P 500 index now registers a cyclically adjusted price-to-earnings ratio, or CAPE, of 39, an unprecedented figure save for the internet bubble's apex in 1999. Simultaneously, within America's commercial property hubs, office buildings that commanded a value of $180 billion in 2021 are now appraised at a mere $90 billion. Yet financial institutions continue to list these assets on their ledgers at $145 billion. These impending deficits remain concealed, unrecognized, poised to detonate. Across the fixed income landscape, $13.7 trillion in corporate debt necessitates refinancing within the ensuing 24 months. This must occur at interest rates tripling the original borrowing costs, an almost certain harbinger of a default wave destined to dwarf that of 2008. However, what distinguishes the impending crisis of 2026 from all prior financial cataclysms is their interconnectedness. These are not isolated issues. The inflated stock market is intrinsically linked to corporate profitability. Corporate profits, in turn, are dependent on the availability of inexpensive debt. This era of cheap debt has irrevocably concluded. Corporations will be compelled to secure new financing at rates that obliterate their profitability. The erosion of profits will precipitate a stock market collapse. A stock market downturn will trigger margin calls. Margin calls will necessitate the liquidation of assets. The forced sale of assets will destabilize the real estate market. The subsequent decline in property values will devastate bank balance sheets, leading to a cessation of lending. The entire economic engine will grind to a standstill. This represents the everything bubble, not merely an overvaluation of equities or real estate, but a simultaneous inflation of all asset classes: stocks, bonds, property, private equity, and even cryptocurrencies. 14 years of zero interest rate policies, coupled with $16 trillion in quantitative easing, have inflated every corner of the asset market to unsustainable extremes. And when every asset class inflates in unison, their eventual correction will also be synchronized. In 1929, equities plunged 89%, yet bonds retained their value. In 2008, real estate values plummeted 55%, but bonds experienced a rally as the Federal Reserve lowered interest rates. Each preceding crisis saw one or two asset classes falter, while others offered a safe haven. In 2026, no such refuge will exist. Every asset class is precariously overvalued and poised for a reckoning. We anticipate stocks declining by 60%, bonds by 40%, and real estate by 50%, all occurring concurrently. There will be no sanctuary. The projected global wealth destruction is $90 trillion, with $35 trillion lost within the United States alone. This magnitude, when adjusted for inflation, exceeds the combined losses of the 1929 and 2008 meltdowns. The decline has already commenced. Commercial real estate values have contracted by 35%. Regional banks have shed 40% of their value since 2021. The fissures are apparent, and the projected timeline suggests the complete unraveling will occur between the second quarter of 2026 and the fourth quarter of 2027, with the most severe damage concentrated within a 6-month span from May to October of 2026. This analysis is not financial counsel. It is a dissection of the mechanisms by which the simultaneous overvaluation of all asset classes by 40 to 150% will precipitate a wealth destruction event unparalleled in history. This is because there will be no diversification, no safe harbor, and no escape route. Allow me to illuminate the 7 distinct bubbles poised to burst simultaneously, the cascading effects they will trigger, and the reasons this collapse will eclipse the combined impact of 1929 and 2008. To comprehend why the years 2026 and 2027 will be more devastating than both prior crises combined, one must understand how current conditions surpass those previous events across every critical metric. The 1929 stock market crash saw equities fall 89%. However, stock ownership was limited to merely 2.5% of the population. While the wealthy bore the brunt of this collapse, it did not directly decimate middle-class savings. Furthermore, as stocks plummeted, government bonds maintained their value, effectively concentrating the problem. The total debt in 1929 stood at 190% of the gross domestic product, a significant but manageable figure. The 2008 crisis was primarily a real estate and credit implosion. National housing prices dropped 33%, with some hard-hit markets experiencing a 55% decline. The stock market itself lost 57%. Yet, U.S. Treasury bonds rallied 43% in 2008 as investors sought the perceived safety of government debt. Gold also saw gains. Diversification proved effective. Crucially, the Federal Reserve possessed substantial ammunition, slashing interest rates from 5.25% to zero and injecting $4.5 trillion into the economy. The government also enacted an $800 billion stimulus package. These interventions staved off total systemic collapse. The aggregate debt in 2008 had reached 350% of GDP. The crisis of 2026, however, is poised to be more severe for 7 specific reasons. Firstly, every asset class is simultaneously overvalued. Stocks are trading at a CAPE ratio of 39. Bonds are overvalued due to suppressed yields from Federal Reserve purchases. Residential real estate has appreciated by 47% since 2020. Private equity valuations are at historic highs. Cryptocurrencies are highly speculative. Consequently, no safe haven asset exists. Secondly, debt levels have escalated exponentially. Total U.S. debt now stands at 140% of GDP, 1.5 times higher than in 2008 and 2.8 times higher than in 1929. When debt is this elevated, defaults become more severe, and the subsequent deleveraging process more destructive. Thirdly, the Federal Reserve's policy toolkit is largely depleted. Interest rates are presently at 4.5%, affording only 450 basis points of potential reduction compared to 525 basis points available in 2008. The Fed's balance sheet is already burdened with $7.4 trillion. Any further substantial quantitative easing on the scale of trillions of dollars risks undermining confidence in the US dollar. The very tools that averted disaster in 2008 have been exhausted. Fourthly, the proliferation of passive investing has introduced unprecedented fragility. $11 trillion are invested in passive index funds, a stark contrast to the $1.2 trillion in 2008. When markets decline, passive fund redemptions trigger indiscriminate selling, irrespective of underlying asset value. Risk parity funds, volatility targeting strategies, and options hedging mechanisms are designed to automatically deleverage, thereby exacerbating downward trends. Fifthly, 58% of Americans now own stocks, a dramatic increase from the 2.5% in 1929. This means the impending pain will be widespread. A stock market crash will directly impact the retirement savings of approximately 150 million Americans. This is no longer exclusively a concern for the affluent. Sixthly, globalization ensures that contagion will spread instantaneously. In 1929, it took months for market dislocations to propagate globally. In 2008, weeks. In 2026, the transmission of crises will occur within hours, facilitated by algorithmic trading, complex global derivatives, and instantaneous communication networks. Seventhly, the sheer magnitude of overvaluation across all asset classes simultaneously surpasses any previous bubble phenomenon. This is not merely one bubble. It is an interconnected web of 7 distinct bubbles. Now let us examine each bubble individually and the cascading mechanism that links them. Bubble 1. Equities. The S&P 500 is trading at 68.99 times its earnings, with a CAPE ratio of 39, significantly exceeding the historical average of 17. For the CAPE ratio to revert to even 25, which is still considered elevated, stocks would need to fall by 36%. The Warren Buffett indicator, which compares the total stock market value to GDP, stands at 230%, versus a historical average of 100%, suggesting a required decline of 56%. Margin debt has reached $797 billion, equivalent to 2.8% of GDP. Historically, whenever margin debt has exceeded 2.5% of GDP, market crashes have followed within 18 months, as seen in 1929, 2000, and 2007. Furthermore, the Magnificent Seven companies now constitute 32% of the S&P 500's market capitalization, trading at an average price-to-earnings ratio of 42, compared to the historical average of 22 for mature corporations. Should these seven giants experience a valuation decompression, an estimated $7.1 trillion in market value could evaporate, dragging the entire index lower. Bubble 2. Corporate debt. A staggering $13.7 trillion in corporate debt is outstanding, representing 47% of GDP. Bubble 3. Commercial real estate. This sector has already declined by 35%, yet banks have yet to fully acknowledge these losses. $1.5 trillion in commercial real estate loans are scheduled to mature in 2026 and 2027. Consider an office building valued at $200 million in 2021, now worth $130 million, but still carried on bank books at $180 million, with $140 million of associated debt. When banks are forced to reassess these properties at their current market value and initiate foreclosure proceedings, they will incur $30 million in losses per building. The total projected losses across all commercial property types are estimated to range from $600 billion to $800 billion. Bubble 4. Residential housing. Prices have surged by 47% since the pre-pandemic era. The median home price has climbed to $425,000 from $289,000 in February 2020. However, mortgage interest rates have more than doubled, rising from 2.7% to 6.8%. At a 6.8% rate, prospective buyers can only afford a home priced at $280,000, whereas at a 2.7% rate, the same monthly payment would have supported a $400,000 mortgage. Affordability alone suggests a price decline of 30%. When a recession inevitably strikes and foreclosures surge, home prices are expected to fall between 35 and 42% from their peak. Homeowners who purchase properties in 2021 and 2022 with only 5 to 10% down payments will find themselves underwater on their mortgages. Bubble 5. Private equity and private credit. $5.8 trillion are held in private equity assets. Leveraged buyouts completed in 2020 and 2021 will need to refinance their debt at triple the original interest rates. An estimated 30 to 40% of these deals are projected to default. The private credit market, comprising $1.6 trillion in non-bank loans with variable interest rates, faces a 12 to 18% default rate as borrowers struggle to meet their payment obligations. Projected losses in this sector are estimated between $190 billion and $290 billion. However, these losses are not expected to be recognized until 2027 and 2028 due to reporting lags. Bubble 6. Cryptocurrency. The total market capitalization of cryptocurrencies stands at $1.7 trillion. When the stock market collapses and margin calls are issued, leveraged crypto traders will be compelled to sell their holdings. Bubble 7. Government bonds. The United States carries $36.2 trillion in national debt, with annual interest payments alone exceeding $1.13 trillion. The government borrows approximately $2 trillion annually. Foreign holders of U.S. debt are reducing their positions. China's holdings have fallen to $770 billion from a peak of $1.3 trillion. The Federal Reserve is increasingly becoming the lender of last resort. If the Fed prints money to combat the crash, inflation will surge. Treasury yields are expected to rise from 4.5% to 6.5% on long-term maturities. Existing bondholders will experience a 28% loss. This risk-free asset will consequently inflict losses throughout the financial system. Now let us examine the critical juncture. how these 7 bubbles will cascade and precipitate a systemic collapse. The cascade sequence begins in the first quarter of 2026. Stocks will decline by 12% due to disappointing earnings reports and valuation compression, triggering margin calls for leveraged investors. Forced liquidations will accelerate, pushing stock prices down by 20% by the end of the first quarter. This 20% stock market decline will decimate $8 trillion in household wealth, prompting consumers to curtail spending. Retail sales are expected to fall by 6% in the second quarter. The reduction in consumer spending will lead to an 8% decline in corporate revenues and a 15% drop in corporate earnings, thereby justifying further stock market declines. Equities will fall by 35% by the close of the second quarter. Concurrently, corporate debt defaults will begin to accelerate in the second quarter as companies find themselves unable to refinance at 6 to 7% interest rates. This wave of defaults will cause corporate bond prices to plummet. Investment-grade bonds will drop by 22%, and high-yield bonds by 38%. Pension funds, insurance companies, and mutual funds holding these bonds will face substantial losses. In turn, they will experience significant redemptions, forcing them to liquidate stocks and real estate holdings, thus exerting further downward pressure on asset prices. The combined collapse of the stock and bond markets will erode bank capital. Banks are exposed to stocks, corporate bonds, and defaulting commercial real estate loans, representing 3 simultaneous sources of significant losses. Bank stocks will plummet, with regional banks experiencing declines of up to 65%. Depositors will begin to panic, leading to a flight of funds from these institutions. Banks will be compelled to sell assets to meet withdrawal demands, realizing substantial losses. Several regional banks will fail, intensifying the banking crisis. This banking crisis will trigger a credit freeze, as banks drastically curtail lending activities. Businesses will be unable to access crucial credit lines. Commercial real estate owners will be unable to refinance their maturing obligations. Prospective home buyers will be denied mortgages. Economic activity will grind to a halt. Unemployment will surge from 4.2% to 7.5% within a 6-month period. Unemployed individuals will default on their mortgages, leading to a spike in foreclosures. Housing prices will fall by 35 to 40% by the fourth quarter of 2026. The housing market collapse will further decimate household wealth. Household net worth will decline from $156 trillion to $15 trillion, representing a $51 trillion reduction. This erosion of wealth will compel households to further reduce their spending, deepening the recession. This will lead to additional corporate defaults and further stock market declines, creating a self-reinforcing cycle. In response, the government will enact measures such as printing money, with the Federal Reserve reducing interest rates to 0. The Fed will purchase $3 trillion in Treasury bonds and mortgage-backed securities, and the government will pass a $1.5 trillion stimulus package. The total money creation will reach $4.5 trillion. However, this will occur amidst a contracting economy and disrupted supply chains, resulting in a CPI inflation spike to 8% in 2027, despite the recession, a phenomenon known as stagflation. This inflation will cause Treasury yields to spike from 4.3% to 6.2%. Existing bondholders will suffer an additional 25% loss. Banks, insurance companies, and foreign central banks will all incur losses on their government bond holdings. Foreign central banks will accelerate their selling of U.S. debt, causing yields to rise further, triggering a broader bond market crisis. By the fourth quarter of 2026, all 7 bubbles will have burst simultaneously. Stocks will be down 58%, corporate bonds down 35%, commercial real estate down 68%, residential housing down 38%, private equity down 35%, cryptocurrency down 72%, and government bonds down 22%. The total wealth destruction in the U.S. will reach $34 trillion, and globally, $88 trillion. Now let us consider the specific timeline. January through March of 2026 will see the stock market decline by 15% due to disappointing earnings. The first corporate defaults will be announced, and the initial regional bank failures will occur. Analysts will remain optimistic, characterizing these events as a healthy market correction. From April to June of 2026, the stock market will fall by an additional 20%, reaching a 35% total decline. The wave of corporate defaults will accelerate, and the banking crisis will intensify. 4 regional banks, with combined assets of $280 billion, will fail in June. A credit freeze will commence, and unemployment will reach 5.8%. July through September of 2026 marks the period of peak panic. The stock market will be down 58% by September, and the volatility index, VX, will surge to 52. Margin calls will force widespread liquidations, and record outflows will be seen from equity funds. Unemployment will spike to 8.1%. Foreclosures will surge, and housing prices will decline by 35%. Commercial real estate will experience forced sales at 50 cents on the dollar. Corporate defaults will peak, with 487 companies filing for bankruptcy that year. High-yield bonds will fall by 42%, and investment-grade bonds by 27%. October through December of 2026 will see a bottoming process. Massive interventions will be implemented. The Federal Reserve will cut rates to zero, engage in $3 trillion of quantitative easing, and the government will enact a $1.5 trillion fiscal stimulus. Markets will stabilize at depressed levels. The stock market will conclude 2026 at 3,310 points. 2027 will bring a slow recovery. The stock market will rebound to 4,350 points by year-end, still 37% below its peak. However, inflation will accelerate to 8%, due to the extensive money printing. Treasury yields will spike, leading to an additional 26% decline in bonds during 2027. Insurance companies will face insolvency, and stagflation will become the dominant economic condition. A full recovery to the 2025 peak is not anticipated until 2030 or 2031. Now let us consider who will be financially devastated and who will emerge intact. The devastated. A 55-year-old individual with $1.2 million in retirement savings, allocated 60% to stocks, 30% to bonds, and 10% to cash. Stocks will fall by 55% and bonds by 25%. The devastated will also include homeowners who purchased at the market's peak in 2021 and 2022 with only a 5% down payment. A house purchased for $480,000 will now be worth $297,000. Workers employed at the 487 defaulting companies will also be devastated, with 1.8 million jobs lost due to bankruptcies, resulting in lost income, health insurance, and worthless unvested 401k plans and company stock. Beneficiaries of pension funds will suffer as these funds lose 45% of their assets, leading to a 30% reduction in benefits. A retiree receiving $3,000 monthly may now receive only $2,100, unable to bridge the shortfall. Small business owners reliant on credit will also be ruined. A restaurant owner with a $100,000 credit line may find it frozen by their bank in July 2026, rendering them unable to meet payroll, forcing closure, and resulting in the loss of invested capital, plus personal guarantees on their lease, leading to bankruptcy. The survivors will be those who recognized the impending bubble and liquidated their stock holdings in late 2025, reallocating 50% to cash, 30% to short-term treasury bills, and 20% to gold. When stocks plunge by 55%, such a portfolio would only experience an 11% decline. At the market's nadir, this strategy would involve deploying cash into undervalued equities. By 2029, stocks are projected to double, resulting in a 49% overall portfolio gain, while others experience significant losses. Survivors will also include business owners with no debt, offering essential products and possessing pricing power. A plumber with zero debt, for instance, will continue to generate profits throughout the recession and use available cash to acquire a bankrupt competitor at a significant discount, emerging from the crisis in a stronger position. Government employees with secure jobs and pensions will also be among the survivors. Their salaries will continue uninterrupted, allowing them to purchase stocks at the market's bottom, leveraging their ongoing income. The compounding advantage over 20 years could translate into hundreds of thousands of dollars in additional wealth. Those who successfully shorted the market or purchased put options at the peak will also benefit. A $50,000 investment in put options could grow to $800,000 when the market crashes by 55%, though this requires exceptionally precise timing and is achieved by very few. The ultra-wealthy will likely survive due to their true global diversification across 30 countries and 12 currencies. While their alternative assets may decline by 30%, a substantial portion of their wealth, for example, $700 million out of $1 billion, will remain, enabling them to maintain their lifestyle. Now consider why governments will be unable to prevent this crisis, despite possessing more tools than in 1929. The Federal Reserve has already employed its primary tools. Interest rates are at zero, and the Fed has injected $8 trillion into the economy between 2008 and 2022, expanding its balance sheet from $900 billion to a peak of $9 trillion, currently standing at $7.4 trillion. If the Fed were to inject an additional $10 trillion to combat the 2026 crash, the total money printing since 2008 would exceed 208% of the US GDP. This action would undoubtedly bring the dollar's reserve currency status into question, prompting foreign central banks to accelerate their sales of US treasuries. Consequently, the dollar could depreciate by 25%, and inflation could surge to 12%. Money printing would become counterproductive, as escalating inflation would erode purchasing power faster than the injection of funds could prop up asset prices. Governments also face significant political dysfunction. In 2008, both major political parties recognized the urgent need for action. In 2026, however, intense political polarization will likely cause Congress to take months to pass essential stimulus measures, thereby exacerbating the crisis. Furthermore, government debt currently stands at $36.2 trillion, representing 125% of GDP. Markets will perceive additional deficit spending as reckless, potentially driving interest rates higher rather than lower, an outcome directly contrary to the intended effect. The government's capacity to avert such a crisis is constrained by the unprecedented scale of its previous interventions, escalating debt levels, and pervasive political impediments. The crash of 2026 and 2027 will be more profound and prolonged than that of 2008 because governmental responses will be slower and less effective. The everything bubble collapse of 2026 and 2027 will exceed the combined impact of the 1929 and 2008 crises because every asset class is simultaneously overvalued. Debt levels are triple those of 2008. Policy tools are largely exhausted. Passive investment flows have created systemic fragility. With 58% of Americans invested in the stock market, the resulting pain will be universal. The magnitude of overvaluation surpasses any preceding bubble. 7 distinct bubbles will collapse in tandem. Stocks will fall 58%, corporate bonds 35%, commercial real estate 68%, residential housing 38%, private equity 35%, cryptocurrency 72%, and government bonds 22%. The total wealth destruction will amount to $34 trillion in the US and $88 trillion globally. The timeline indicates the crash will commence in the first quarter of 2026, accelerate in the second quarter, peak in the third quarter, and reach its bottom in the fourth quarter of 2026. A recovery will begin in 2027, but will be plagued by stagflation. A full return to the 2025 peak is not anticipated until 2030 or 2031. Many assets may never fully recover their former valuations. You have a 3-month window from January 2026 onwards to reduce your exposure to overvalued assets, build cash reserves, and prepare to navigate the most severe financial downturn in modern history. The underlying mathematics guarantee this outcome. The intricate interconnections within the financial system necessitate it. The crippling debt levels demand it. The collapse begins in the first quarter of 2026 and concludes by the fourth quarter of that year. Those who prepare will survive and be positioned to invest at the market's bottom. Those who disregard these warnings risk losing 50% of their wealth and may never recover. The pattern is undeniable. The timeline is established. The everything bubble is destined to burst. And when every asset class is simultaneously overvalued, every asset class will correct in unison. There will be no diversification, no sanctuary, and no escape. This analysis is not financial advice. It is an assessment of systemic risk, demonstrating that when equities, fixed income, real estate, and all other asset classes are simultaneously trading at historic valuation extremes, while debt levels are triple previous peaks and policy intervention tools are exhausted, the ensuing correction will unleash a level of wealth destruction unprecedented in financial history, precisely because there will be nowhere to seek refuge.